So we have now studied the business cycle. Let's take a look at some implications of the business cycle in terms of investment decisions and investment strategies. How do we invest in response to where we are in the business cycle? So history shows us that stock and bond returns are strongly correlated to the economy. So there's a strong relationship between the economy and stock and bond returns. For example, stock prices tend to peak, they top out about 6 months before the economy turns down. So stock prices always look forward 6 to 9 months, and so stock prices will turn down before the economy turns down, because the stock market and stock investors try to anticipate what will happen. We call that the discounting process. Okay? Stock prices tend to begin rising about 5 months before economic activity bottoms out. So prices go down before the economy goes down, and stock prices start going up before the economy recovers. Okay? These lead times have varied over time. Every cycle is a little bit different, and sometimes these lead times are longer, sometimes they're shorter. Okay? Similarly, during mild recessions, the average stock market decline is about 20%. We call this a bear market, a 20% decline from the peak of the market to the bottom. It happens typically during mild, or what we call garden variety, average or typical recessions. However, during severe recessions, where the economy slows down a lot more, is very negative, where unemployment rises, where plant capacity falls significantly, the loss in the stock market will double to nearly 40%. Okay? Therefore, the possibility exists for investors to significantly improve returns by closely monitoring the economy. If you see the economy slowing down, it is time to lighten up your stock holdings. Now, remember that you might have a stock holding range of, let's say, 60 to 70%. I'm not saying that you take your asset allocation in stocks to 30%. That is a huge bet, and I wouldn't do that. But I would most certainly trim it back. If it's 60 to 70% stocks, I would take it to 60%. You might get really aggressive and take it to 55%, but I wouldn't go much beyond that, because it's really difficult to know exactly when the economy is going to turn down, or when the economy will recover, and the timing magnitude of those recoveries. We'll talk about that in just a minute, and of those downturns. So the business cycle has a profound effect on corporate profits. How the business cycle operates, where we are in the business cycle, will have a profound effect on company profits, on inflation, and on interest rates. So by monitoring the economy, investors can get invaluable insights as to the likely future trends of these key variables. Watch the economy, and you'll see corporate profits, and you'll see interest rates, and you'll see inflation all adjusting to the economy. All right, so here are some important things to remember from what we've covered so far. The economy follows a general pattern, but each business cycle has its own unique characteristics in terms of the magnitude and the timing of the changes in the economy. Industries respond in different ways and at different times in the business cycle. The table on the next slide illustrates the basic relationship between the stock price performance of various industries and the business cycle. So we're going to take a look at which industries do well in different parts of the cycle. That should be helpful and interesting. All right, so let's take a look. In the early economic phase of the early recovery phase of the economic cycle, that you want to buy credit cyclicals, things that respond to interest rates in a big way, and that would be housing, autos, furniture, appliances, and transportation. In other words, interest rates going down has a huge effect on the business prospects and the business activity for these industries: housing, autos, furniture, appliances, transportation. Okay? So you want to be in these stocks as the economy is recovering. Okay? Then you have the expansion phase, and you want to be in the industries, the stocks of companies in energy, oil and gas, in capital goods and equipment, so industrial building and all kinds of equipment, computer equipment, machinery, okay, and also consumer cyclicals and retailing. They do well during the expansion phase. And then in the overheating phase, you want to be invested in stocks like basic industry, paper, steel, chemicals, metals. These tend to do well in an inflationary environment, okay? But as we start heading into the recession, you better pull the trigger on these stocks, okay? Then in the recession, where do you want to emphasize? Utilities, consumer staples like food and beverage, healthcare, and financials. Those are the industries that tend to withstand the downturn much better, okay? So that's a time to be defensive, and these companies and industries tend to do better in the downturn than these up here, okay? So if you can get the economic cycle right in terms of forecasting and move in and out of these sectors, it's called sector rotation, then you have a good chance of generating a very nice rate of return for a portfolio. Very difficult thing to do, I must tell you. Okay, so recognizing the business cycle where we are and incorporating it into your investment strategy can improve your returns. All right, so let's look at forecasting the economy using the cyclical indicator approach. The cyclical indicator approach. So we're using economic data to help us determine where we are in the economic cycle and where we're going. Okay, so there's a group called the National Bureau of Economic Research, and now operates out of Columbia University in New York, and they have examined the behavior of hundreds of time series or signals, economic data. And they grouped these series into three major categories. Okay? First, leading indicators. What is a leading indicator? These are economic time series or data that peak or trough, so they hit the top or the bottom, before corresponding peaks and troughs in the overall economy. In other words, as we're looking at these indicators, they give us an idea of where the economy is headed, down and up. All right? There are 11 components or time series in the leading indicators group, and they include things such as stock prices. As you might expect, stock prices are a leading indicator. Stock prices tend to fall 6 months before the economy falls and rise 5 months before the economy starts to rise, so they're leading economic indicators. Changes in the money supply. When the Federal Reserve starts shrinking the money supply or shrinking the growth rate in the money supply, the economy will follow a few months later, going in the opposite direction. So well, actually in the same direction, because if the money supply is shrinking, interest rates start going up and the economy goes down. And that takes a few months to happen, okay? Building permits. These are applications to build a building. And so when you see building permits rising, that means the building will start taking place and the economy will increase or rise. And then industrial orders. These are tracked. These are orders that will turn into sales and will turn into inventory and will turn into hiring of people. Okay, so when orders are rising, a few months later the economy is going to rise. Okay, and then the level of business and consumer debt. If business and consumer debt is rising, that means people are borrowing and spending more. So these are all major data series that economists and investors look at to give us an idea of where the economy is likely to go, up or down. All right. The second group is coincident indicators. So we looked at leading indicators, now we're going to look at coincident indicators. Okay? And these are economic time series that peak and trough at the same time as the economy. Okay? At the same time. And there are 4 components, and they include things like business sales and retail sales. So we get data on retail sales, and that data tells us how we're doing now. It does not give us a look into the future. It just gives us an idea of how we're doing now. Industrial production, okay, and that's generally service and manufacturing, primarily manufacturing, okay? And then the employment data. What is unemployment? How many new jobs are being created? These are all coincident indicators. How are we doing now? But they don't give us any look into the future. And then we have the lagging indicators. And these are economic time series that peak and trough after the economy. So as we're following this data, we must keep in mind that the economy has already turned, okay, when we see this data. And so these things include the prime rate. After the fact, the prime rate is going up. We know the economy is going to start turning down, or the prime rate goes down. It's already been too late, the economy's already turning down, the prime rate turns down. Labor costs, okay? Once labor costs, they're getting higher and higher, the economy's going to start turning down. We can't afford it. We're going to have inflation. And the ratio of inventories to sales. These are all lagging indicators. The overall economy has already turned one way, either up or down, and these things are lagging behind. So when we look at these things, we must know that they don't tell us what's going on now. They don't tell us what is likely to go on in the future. They tell us that things have already turned in the economy, either positively or negatively. All right, now let's note some shortcomings of trying to forecast the economy using this data. These indicators do have predictive value, but they do have some shortcomings. For example, these series or economic data often give false signals. They indicate that something is going on when really nothing is going on. Okay? This usually occurs with a signal of an economic downturn that does not actually materialize. So often the data will indicate the economy is going to slow down, and the economy in fact does not slow down. So this is called a false positive or a false negative. Secondly, they cannot predict, this data cannot predict the magnitude of the economic change. So it may give us an idea that the economy it will turn either up or down, but we don't know how strong that move will be. And then lastly, we don't know when exactly the economy will turn up and down. We just start seeing this data and changes in the data and gives us a sense that things are changing, but we don't know exactly when and by exactly how much. So these are shortcomings that we have with trying to forecast the economy. All right, let's look at some important economic and security market relationships. So how the cause and effect connect the dots. Money supply and stock and bond prices, how are they related? Studies show that the economy and the financial markets respond to monetary policy. This is what the Federal Reserve does. Okay? Slow growth of the money supply and rising interest rates have preceded virtually every recession and every bear market. Interest rates start to go up with the economy, and for a while they really don't have any impact on the economy. But after they reach a certain level, they will start to choke off economic growth. When interest rates get too high, it will start to choke off economic growth, and we'll have a downturn in the economy, and we will have a downturn in the markets. So if you're going to watch anything, you watch interest rates. You watch the Fed, watch interest rates. Faster growth of money supply and falling interest rates has sparked virtually every economic recovery and bull market. So back in 2009, during the crisis, what did the Federal Reserve do? They very aggressively pumped money into the system. And what happened in the stock market? We had 8 years of a bull market. Okay? What's going on now? Now the Federal Reserve has slowed the growth rate and is pulling money out of the system. And you watch what happens. If they keep doing it, and they probably will, at some point the economy is going to slow down, and you'll see the markets pull back in a very significant way. Okay. So when money goes into the system, where does it go first? It goes into the stock and bond market. Okay? Investors always respond to an anticipated increase in the rate of inflation, and when does that happen? Toward the end of the expansion and the beginning of the overheating. And so what do investors do? They demand a higher rate of return with inflation, particularly bond investors. And accelerated inflation always leads to rising interest rates, because inflation is a component of interest rates. And since bond prices are negatively affected by rising interest rates go up. Inflation goes up, interest rates go up, bond prices go down. Accelerating inflation always leads to falling bond prices. It's like a chemical equation. It is a sure thing. Rising inflation leads to higher interest rates, which leads to lower bond prices. And this year, what's happened to the bond market? They're all negative. Short, medium, and long, corporate, and Treasury, all bond returns are negative in 2018 because of rising interest rates, rising inflation, rising interest rates. It is worth noting that investors rarely anticipate the magnitude or the timing of the change in the inflation rate. Inflation is really difficult to forecast, okay? Because it's hard to forecast inflation, you could forecast a general trend, but it's really hard to know exactly how it will change over time. Interest rates, it's really difficult to try to forecast interest rates and bond prices, but you just follow the Fed, follow economic activity, follow inflation, and if economic activity is ticking up and the Federal Reserve is pulling money out of the system to raise short-term rates, you can bet long-term rates are going to rise too and bond prices are going to fall. The effect of inflation on stock prices is not as direct as it is on bond prices. It is true that rising inflation and rising interest rates raise the required rate of return for equity investors. So if the required rate of return goes up, that means multiples and prices go down, okay? And this will negatively affect stock prices. It's a negative for stock prices. However, some companies use inflation to increase prices of products and services. That's what inflation is. Prices go up. And therefore, by raising their prices, they maintain their profit margin, and sometimes they even increase their profit margin, okay? Faster earnings growth in an inflationary period will partially offset the increase in the required rate of return. Remember, a stock price, stock multiples, are a function of, a stock price in particular, is a function of cash flows in the numerator and the required rate of return in the denominator. If the required rate of return goes up, but cash flows go up by more, then stock prices and multiples will go up despite the fact that interest rates are going up, because cash flows are going up by even more. But at some point, as that required rate of return goes up, at some point, cash flows will slow and even turn negative, and then we got a big problem with stock prices. Generally speaking, stocks have not been a great hedge against inflation. When inflation is high, some people will say, well, stocks are a good place to park your money because of the increase in cash flows. And that is generally not the case. Over a long period of time with rising inflation, stock prices are not a good place to hide. Stocks are not a good place to park your money. Okay. But there are certain industries within the market that do respond more positively to an inflationary environment, and these include basic industries that extract or process commodities like metals, papers, and chemicals. Remember that in the overheating phase, these industries tend to pass price increases along more rapidly than inflation, and these stocks tend to do better in the late stages of an economic cycle. All right, I think we are done with this clip, and we will move on after a brief pause. Until then, peace out. Shalom.